Hello everyone, I am Varsha. I will be going to present on the section 278 penalty for underreporting and misreporting of income. So, overview of section 278. It was effective from 1st April 2017 for assessment year 17-18 onwards. It covers penalty for underreporting and misreporting of income. Assessing officer, Commission of Income Tax, Professional Commission of Income Tax may level penalty depending upon whether it is underreporting or misreporting of income. It depends on the case. So, reporting of income occurs when the income exceeds the income filed in the return. Now see, there are four scenarios we can say. Income determined difference, when the assessed income is greater than return income, and when no return has been filed, it is greater than your basic exemption limit. Whereas in case of deemed total income under special tax 115 JP and 115 JC, total income assessed or reassessed is greater than deemed total income. In case of loss computation, your loss is less than whatever you filed in the return. So now let's see what is misreporting of income. Misreporting of income may be mainly because of four. One is misrepresentation of facts, failure to record investment, claiming false deduction, transfer pricing alteration. Misrepresentation of facts means either your claim or statement you're putting something which is false or which is not true. Whereas failure to record investment means you're not recording some transactions, or you're recording transactions which are not real. Whereas claiming false deduction is like fraudulent expenses and some additional expenses you're adding which doesn't even which you can't even claim, ineligible exemptions. Transfer price valuation means incorrect arm's length, when where you have made the undisclosing international transaction and documentation failure. Now, so penalty structure, there are two types of penalties. For underreporting, it is 50% of the taxpayer, whereas for misreporting, it is 200% of the tax payable. Now, for example, let us consider Mr. A. He is a business owner. He is having total income of 15 lakh for assessment year 2024-25. However, he underreported his income of rupees 5 lakh and misreported income 2 lakh rupees, which was claiming as inadmissible expense. Now let us assume that penalty is 30%. So whereas in case of penalty for underreporting, now 5 lakh ka 30% will get rupees 1,50,000, and rupees 1,50,000 ka 50% if we take rupees 75,000. Whereas penalty in case of misreporting will be, now rupees 2 lakh is the deduction which was actually not allowed, but he has claimed that. So that ka 30% if we take rupees 60,000, and rupees 60,000 ka 200% is the penalty, so rupees 1,20,000. So total penalty for Mr. A under section 270A will be rupees 1,95,000. Now exemptions and relief provision under section 270A. Now this exemptions is only available for underreporting. These exemptions we can't claim for misreporting. Now this exemptions or immunity you can claim only if you make full disclosure, like you have given whatever all the disclosures, like why you have underreported, and bona fide explanation, you have a proper explanation of underreporting. And tax payment, you have paid additional tax within the proper time or before issuing of the notice. So what's the main difference? Now I am going to tell about difference between underreporting and misreporting. Underreporting occurs unintentionally, whereas misreporting occurs with the intentionally. Here your underreporting might be because of by mistake or incorrect deductions and all you're claiming, but this you're misreporting, you're trying to hide some facts or whatever. So here penalty is 50%, whereas in this case the penalty is 200%. For example, we can see misstatement in calculation of income or claim. Here it is suspension of fact. Whereas what is the legal consequence? In case of underreporting, you can claim the immunity, whereas in case of misreporting, you can't claim immunity. Penalty of 200% will fall. So what can you do? So key takes away from the taxpayer, you have to maintain your proper books of accounts, maintain all your income, expenses and everything. Cooperate with the authority that can help you avoid the penalty or whatever, reduce your penalty. Seek professional advice, whatever it is, consult a C or anyone who is professional to ensure the compliance, and so that it doesn't fall under section 270 or anything like that. Thank you.